a joint venture or something like that. That's merging. Another reason why business valuation is done is to attract new investors. To attract new investors in the business. Okay. You would find that the company has been making losses for quite a number of times. And much as it's trading its shares on the stock exchange, many people wouldn't be willing to buy that company, to buy shares in that company. So there's always a need to triggers management to make sure that the company is operating perfectly, and it attracts a lot of shareholding or a lot of buyouts on stock exchange. Another reason is that it enables the managers to buy, to enable managers to buy the business, its owners. Remember, sometimes some managers will be given a chance to buy the company from the owners. If the owners are tired running the company, they would offer it to managers who've got enough capacity in their pocket and allow them to buy the company. And it should also be noted that in nature, there are quoted companies and unquoted companies. For quoted companies, these are companies that already have a share price valuation. Okay. When we say share price variation, basically we're looking at the current market price of the shares. So the main reason for making business valuation for quoted companies is when there is a takeover bid. Okay, you know what a takeover bid is?
No.
A takeover bid is when company is offered for sale. So what happens is that in a case of takeover bid, the bidder always offers more for the shares in the target company than their current market price. It's like different companies are bidding. They're bidding to buy, or they're offering a price at which they should buy the company. So evaluation might be made by the bidder in order to establish the fair price or the maximum price that the bidder will be able to pay for the company. Okay. So for unquoted companies,
That one is number 30 na?
yes.
Okay.
Okay.
But it seems like you are specific. That reason is specific for
Quoted companies.
particular type of company.
Yeah, like quoted companies, the company that sells its. Remember here, I'm just listing the reasons why there might be a business valuation or circumstances that triggers business valuation. Then I'm splitting the circumstances into two parts. The circumstance that may happen in a company that is called quoted share price, or companies that sell the shares on stock exchange. You understand?
Okay.
Yes. Now there are those companies that don't sell the shares on stock, like closed companies, private companies. They are unquoted companies. Okay, where business valuation may be triggered by, let's say, if they want to register or list their company. I've already put it here. Number one, to list the company on stock exchange. Okay, where the company might be converted into a public company, a closed company, or what do you call proprietary, a limited company, may be converted into a public limited company with the intention of launching it on the stock exchange. So when a company comes to the stock market for the first time, an issue price of the shares has to be decided. So who decided? The company hires an expert. So when you become a certified chartered accountant and a registered expert for business valuation, okay, you can be contracted as an expert to value the business. That's why hence we are learning this thing. You understand?
Yeah, bro.
Okay. So last time we met, we also talked about the method of valuation. But what we should remember, there's a number one rule. The number one rule for business valuation is that you must remember. You must remember that business valuations, these things, business valuations are subjective in nature. What do we mean when we say they're subjective? I'm asking you guys question. What do we mean when we say business valuation are subjective in nature?
I think we were talking about the fact that
Sorry.
it
Hello?
depends on which method that we use. So objectiveness is a fact, right?
Yeah.
Subjective is more on the perspective.
Yes.
So yes, I would
So what?
say
Yeah.
I would say very much it's more on the method that is used to calculate the valuation of the company
Okay.
that determines the subjectivity part.
The subject, just to add on that, it's subjective in nature between who? Between the buyer and the seller, the bidder and the owner, the bidder and the seller. Okay. So what we're trying to say is that there is no right price. There is no right price such that a company is worth what the partners do or what the buyer and the seller have agreed to transact. You understand? Are you following me now?
Yes, yes.
Yes, yes.
Okay, you should, because you are moving at the speed of light now. Okay. So another point to note, I remember last time we met, me and Sydney, we also touched on methods of valuation. Methods of business valuations. What method do you remember, Sydney? Or my friend Ashlaf?
If I am correct, we're using our equity element.
Yeah, what about equity element?
I don't remember precisely to the
You
exact.
must always go back to your book and read. Okay,
Yeah,
I emphasize on the point of understanding what we discuss. Because Mina, I've already written exams. Now it's your turn to write exams. All right. So if it's your turn to write exams, you must always understand when we discuss here, it's not final. I'm only contributing 10% to your passing ability. We're now gonna do the 90 part, the 90%.
yeah,
The
that's true.
10% is being contributed in a way of introducing the topic to you, simplifying the topic in a way that you can easily understand. And I most of the times you see me repetitive. I repeat. I repeat with the aim of you guys should understand. So we talked about the net asset method. Net asset method. You remember now?
Yes.
Net asset valuation methods.
Yes.
Net asset
Valuation.
valuation method. Then I told you that today we're going to talk about another interesting area where we talk about income-based valuation method. Income-based valuation methods. Quite interesting. Under income-based, that's where we look at what? Price earnings ratio. You're going to look at price earnings ratio. Okay. Number three, if time allows, you're going to look at the dividend valuation models. Okay. And just to recap, and income-based valuation, there's also another area that we look at, earnings yield method. Okay, these two here. That will be our interest. And there's also another method that is called present value method. Number 4. Okay. So just a recap on what do you call net asset valuation model. Net asset valuation models. What did we say, my friend Sydney? Net asset valuation model. What is it that we talked about?
We're talking about that we should establish our non-current assets,
Mm-hmm.
the value of our non-current assets, deduct our current assets from total assets.
Okay. Are you talking about the net assets?
Oh, I think I made a mistake there.
So, long and short of the story, my friend, is that when you're valuing a business using the net asset valuation model, we use the balance sheet. We use the balance sheet or statement of financial position. Okay, where we look at the net assets, and where net assets shall mean, okay, where net assets shall mean total assets less current liabilities. Okay, you recall now.
Yes.
So under the net asset valuation model, we are looking at the net assets according to the balance sheet. Net assets according to the balance sheet. What is a balance sheet? Okay. No one wants to answer. There's no right or wrong answer. You just have to express yourself. Here is a platform where you express yourself. If you go astray, we're gonna call you back. Never to go astray. Okay? Are we together, guys?
Yes. Yes.
Mm. Okay. So the weakness of using the net assets or using the balance sheet model or using the net assets according to the balance sheet is that it becomes relevant as the numbers used are historical. Why are we saying the numbers used are historical?
We're using previous or prior years statements.
Mm.
Yes.
We are
So
using, of course, balance sheet. We're talking about the balance that has already been prepared for,
yeah.
and in that balance sheet is called historical. It's called numbers from somewhere else, from
Mhm.
long time ago. Okay, and we're reporting as a present value of those assets and liabilities. So these numbers can easily be manipulated just to present a fair value of the business. Okay. Under the net asset valuation model, there's also another thing that is called the net realizable value. Realizable value. What is the net realizable value? Hmm? This is simply the value at which the business can be sold or realized. Okay. The weakness is that okay, let me not talk about the weakness, but the strength of this method, um, or I should indicate that this method is used mostly in times of liquidation. What is liquidation? Are we together, guys?
Yes.
What is liquidation? What is to liquidate?
Yes,
Liquidation
yes,
shall
yes,
mean,
yes.
yeah, sorry, yeah, you can chip in. Ashraf, you can speak.
Can easily be converted into cash.
Mm. At a point of selling the business. Okay. That's when the valuer sit down and make valuations for the business, the assets, liabilities. If you had to sell all assets and pay off our liability, the residue that you have, it's what is called a realizable value. Okay, the residue that you have and you add a profit on top of it, that's a realizable value or the sellable value of the business. This method is useful, to the seller. Why is it useful to the seller? As it gives the minimum acceptable value at which the business can be sold. Okay. So, and do you have a question, guys? Before I proceed, I might be preaching, and you're not getting the concept. Do you have a question,
No,
guys?
no. It actually does make sense.
Okay. Another method under what you call net asset
Sorry,
valuation.
excuse me.
Sorry. Mm-hmm.
May I have a question? May I have a question?
Yes.
On point number 1.1, net assets valuation models, you have said
Mm.
that we do use historical ones. So let's say we have given the balance sheet, whether balance sheet or the other one is what we use balance sheet or what balance sheet or statement of financial position, which is the balance sheet. So we
Yeah.
use the historical value. Do you mean the current value, which is not the historical ones? We don't bother to use them, or we just strictly to focus on historical, only historical figures, only historical numbers.
In understanding how we come up with a balance sheet, chief, we use historical numbers. The value of that asset is a historical cost. Why is it historical cost? It is cost less accumulated depreciation. You understand?
Mm.
Or I should say that We would be in 2025 financial year now, and the balance sheet that can be used is not the one for 2025, or even if we use the one for 2025, either or. We use the balance sheet for 2024. It's a period that has already passed. That's why we're chipping in the word historic. So the word historic is twofold.
Okay,
Are
okay.
you following with me now? Are you with me now? Don't get lost.
Yeah, we are together.
Mm.
Okay, go on, sir.
You also in the balance sheet you would have a line for trade receivables. Those trade receivables are amounts that as a business you say I'm expecting to receive. Why are they historical? You would find out that the company that you sold your things on credit has closed or it's liquidated already. Hence, the numbers are easily manipulated. As long as using accounting policies, the numbers are easily manipulated. That's a thing about it. Okay, so let me continue on 1.3. Or do we have another question? No. Okay, there's another. No question.
No questions.
On net asset valuation model, there's another method way of valuing the business that is called a replacement. Replacement cost. What is replacement cost? The cost at which the cost at which the business can incur for setting up a similar business somewhere else. Okay, you will find out that business can be valued at a cost at which the owner of the business will tend to ask themselves to say, if we want to move out of South Africa and we want to sell our business, how much will it cost us to set up the same business in Malawi or in the United Kingdom or in Botswana or in Zimbabwe or in Zambia? How much the cost will they be for us to set up the similar business in nature? So that is the replacement cost. So this method is suitable. This method is suitable to who? The buyer. Why is it suitable to the buyer?
Because in terms of cost,
Mm.
now they can analyze whether maybe in that sense it is worthwhile for them to buy or to
Mm.
asset.
So, mm. So when you're buying a business, Chief, you're buying the customers also. You're buying an existing infrastructure. Okay, that is got human capital. That's got financial capital. That's got already strength. It has already established itself with a good name. If the company has got a good name, so you're buying an already made company. Okay, no, you're not starting from scratch. It's different to start from scratch because getting customers is not easy. If there are companies that have closed up, it's because they were not able to sustain themselves in terms of financial capability. Okay, they were not able to earn. They are not able to get customers. That's why we learn about the corporate failure, why businesses fail. So if you're selling your company using replacement cost, it's beneficial even to the seller because you're not losing anything. In most of the times you break even. You're just moving away from one regulation to another regulation. You're gonna be comfortable trading your business. All right. So now there are limitations using asset valuation methods. What do you call limitations? for using asset valuation method. Or maybe before I go there, let's have a hypothetical question or an example where we can calculate the value of a business using net assets. Let's say ABC company reported the following balance sheet for the year ended FY 2023. Okay, assets. In terms of assets, there are non-current assets. So I'm gonna have hypothetically property, plant, and equipment, or office building, and land value. That is 2 million. Okay, these amounts are in Rosa. Okay, 2 million. 1, 2, 2, 3. And property, plant, and equipment. Property, plant, and equipment. We've got 12,600,000. Uh, 120. Okay. Then we have our current assets. Hypothetically, we've got inventory. Uh, 630. And before here, let's have what is called goodwill. Assuming there's goodwill of 20,000. And inventory, then we've got cash at bank. Let's say 6 million. Inventory is due this. Okay. Maybe before we do that, let's have trade receivables. Trade receivables. 890, 640, 68. Okay. Total assets. And we got equity. Let's say we have share capital. One rand. 1 rand per share. 1 rand per share for 10 million. 10 million shares. 1, 1, 2, 3, 1, 2, 3. Okay. $10 million. 1, 2, 3, 1, 2, 3. And we've got retained earnings. I'll put the number later. Okay, then you have non-current liabilities, non-current liabilities. Okay, we have 10% or 12% bonds, hypothetically. Hypothetically, we have 12 million. Place of hypothetic. Okay. Then we have deferred tax. Oh, let's have another facility. FNB, FNB or bank loan 48. Place of 69 million. So guys, might check time since we are building from scratch. Bear with me. Okay. And let's have current liabilities. We can have trade payables. $16 million. Okay. Okay. We have a balancing figure. Okay. Deferred tax. 12, let's say 13 million. Okay. And have retained earnings here for the balancing figure. Okay. It means our assets are balancing with our liabilities. Okay. So if we are using, are you with me now, guys? Hello?
Yes, sir.
Is Sydney here?
Yes, I am.
Okay. So if we are using net asset method to value this business, how much would be the share price? What should we do?
To determine the number of shares, of course.
Okay. We are given the number of shares, and then
also now we determine our net assets.
we determine our net assets. Where net assets, we are saying what? Net assets is what?
Is our assets in total minus our current liabilities.
Okay. Assets in total, we are talking about this amount here, right?
Mm-hmm.
Okay. I'll put it there. These are total assets. All right? But we need to take out goodwill. Why are we taking out goodwill?
Because goodwill is, you mentioned this. You said goodwill involves the.
And cash.
Okay.
You remember? Here we are talking about human is cheap.
Yeah.
Can you sell goodwill from nowhere?
No.
You have got goodwill here. I'm selling goodwill. You can. So I'm taking out goodwill here. Okay. So here is the value of our total assets, right? Now I need to determine the number of current amount of current liabilities. Yeah.
Yes.
Current liabilities. What's the value of current liabilities? Is equal to sum open bracket.
16 plus 13.
Okay.
Do we
Yeah.
add the
This plus this.
okay.
Okay. Which is 200 and what? Is it 29? 29 million. So the value of my assets is this one.
In the
Suppose.
case where, can I ask before we just continue? In the case where you have the long term loan, and then you tell you the short term component, you also as well add it to the current.
Yeah.
Okay.
Mm.
Okay. I know. I just wanted to understand.
So if we had, let's say, preference shares,
yes,
and short-term loan, like an overdraft,
yes,
you would find out there's an overdraft. You cannot value a business with an overdraft. You need to take out the overdrafts, pay the overdraft.
mm.
Okay. In this case, whoever is buying the company is going to buy the bank loan as well.
Okay.
He's going to be willing to buy the bank loan. That's why it's on valuing and valuing the net asset of the business. We are living there. Are you with me?
Yeah, I know. I hear you very much.
Are you with me, Bwana Ashraf Ishmael?
Yes.
Okay.
Yes, sir. Yes, sir.
So if we had preference shares, I would chip them in to remove from 100 million. If we had deferred, okay, we already have deferred tax as a liability. Okay, fine. Let's move on. And value of shares or number of shares. Number of shareholders. Huh? Number of shareholders is how much? 10 million. Did you see the 10 million? Or do you see the 10 million?
Yes, I get it. It's share price. 1 rand share for 10
Share
million.
price is how much now? This divided by that.
Okay.
It's 10.05.
Mm.
10.05, which is roughly 10 rand per share. That's how much you're gonna sell this company at. Are you with me, guys?
Sense. Yes.
Okay. So let's look at, or is there any question before I move? Any question before I move on, guys? Remember, it's your time to ask questions. You must ask questions if you feel like asking questions there.
This one.
Don't feel intimidated. Here we don't intimidate each other. Here we are helping each other to be better accountants, right? Okay, so here I'm going to talk about the key limitations. Key limitations for using net asset valuation model. All right. Number one, it's using historical data. You agree? It's using historical data that can easily be manipulated. Two, it does not focus on the future. So the same method, the same reason we put up the say it's using historical data, it's not valuing the business in the future terms. Are you with me?
Yes.
Yes, yes.
Number three, it fails to consider the value of intangible assets. such as goodwill, brand, skilled staff. What else? You will find strong management, etc., etc. So those are the key weaknesses of using net asset valuation model or net asset value method of valuing the business. Now, we remember last time we touched the topic of dividend valuation.
Yes. Yes.
Yeah, so that's another method of valuing the company. Dividend valuation method. Here, I'm not gonna bother with calculations because we've calculated a lot. We talked about dividend growth model here. You remember? I hope you do. Okay, I'm gonna just sum up in a way. Let me just copy the formula. Where is the formula here? I'm forced to type it. Okay. All right. So dividend valuation model. What are we talking about? Or what did we talk about? In terms of business valuation, it is useful for valuing the minority shareholders of the business. Okay, basically what it does, it calculates the value of the business, or the value of the future dividends. Okay, to be received whilst taking account of the dividend growth. Remember the formula we are saying. In the formula, we're saying that share price is equal to. Do you remember the formula?
Share price is equals to
Mhm.
D0 over KE.
Remember, we are considering growth, KE
Okay.
minus G.
Minus
So
G.
D0 open bracket 1 plus G divided by KE minus G.
Alright.
Is there any problem there, guys? I agree.
So instead, if we use basically with D0 plus bracket 1 plus G, I get it's D1. So some formulas we can just say D1 is over KGO minus G. KE minus G. Is that still the same thing, right?
But KE, we can use CAPEM. You remember you use CAPEM to find KE. In
Yeah.
cases where you're not given the KE, you can recalculate that.
Okay.
Yeah. So in emphasizing the issue of dividend valuation model is that it is more objective and it's cash-based approach. Okay. It is more objective and it is cash-based approach to valuing shares because it talks about dividends. if you are to value the share now, what is the dividend growth in the future? Looking at D0 now. You understand? Smallest mechanism is smallest price earnings ratio. So just to add, the basic assumption in using dividend valuation method is that with dividend valuation, the basis assumption with dividend valuation method or the dividend valuation model is that the value of the shares, I'm sure you're writing it for you not to forget next time we meet.
Yes, we are writing.
I hope so. The value of the shares to the shareholders. Is the value of the future dividends that will or future dividends the shareholders I expect or they expect to receive from the existing shares, from those shares. Okay? We are talking about the future. So shares in the future. Okay. So what do you think is the weakness of using dividend valuation method?
It only focuses on minority shareholders.
You are hitting because I mentioned about the minority share. Not necessarily. Not necessarily. It depends on limitations. It depends on the assumption that or we can rephrase it to say it depends on accurate estimate. It depends on accurate estimates of the cost of equity, of growth.
Sorry, sir. I can't see that page you are writing now. You are typing.
Or you can see. Let me scroll up a bit. Can you see now? Can you see? You can see it?
No.
How?
It's only a formula here. I can see only a formula.
Sydney, can you see what I'm displaying here?
Yeah.
Yes, I can.
Now it's coming right.
Yes, I
Now
can.
it's coming right. It could be your network. So dividend growth model, it depends on accurate estimates on the growth and cost of equity. Okay. If you don't have an accurate estimate there, the problem, the higher the problem. Okay. Growth and KE. Another weakness is what? Or limitation. What I can think of, just looking at the formula. It assumes that the growth will be constant. Whereas in real life, that growth can do take a take. It can be constant, depending on the economy and what the company is passing through. and the decisions that are made by management and those charged with governance. Are you with me?
Yes.
Okay. I would love to give an example of this one. Let's look at one example. A company, hypothetically, company ABC is expected, the company is expected to pay dividends or to pay annual dividends, can be half year or annual dividends of $0.48 per share into a foreseeable future. Okay. And the shareholders costs of capital is, say, 12%. Okay. The most recent annual dividend has just been paid. Required. Using the dividend valuation model, suggest what the value of the shares should be. B. Let's say this should be A, and let's have a B here. Okay. Show how the valuation should change. Show how the valuation should change. If the expected annual dividend, in future is 0.54. Okay, let's try to attempt this question. How best can we tackle the question? Or do you understand what is happening? We should use all the formulas we learned, convertible or CAPM or what dividend growth, or the other one, cost of equity. You remember? We talked about several things. So here we can employ all the guns in order to find. Or I should add another question. I should add a C. Let me add a C here, so that we expand our content. Okay. And we can stop from there, assuming we get it right. Okay. See, we can say show how this valuation would change if the expected if the expected annual dividend in the future yields or in the future years is $0.48, but the cost of equity capital holders, cost of equity capital holders is increased by 0.5 or is 12.5%. Okay, let's start with the first one. Or I should ask you, how do you understand the question? Gents, how do you understand the question? Tell me what you're thinking first.
So, in terms of the required, I think we should note down the formula first, and then figure out which component is available to us.
Or let's note down the components that are given, then we decide the formula. Remember, sometimes it's not straightforward. Eh? A company is expected to pay annual dividends of what? 0.48. So D is what?
It's D0.
It's 0.48, right?
Hmm.
0.48. That's what we are given. And you are also given the cost of capital into foreseeable future shares. Cost of capital? Cost
0.212.
Cost of capital. Let me do this. D is 12%. KE. Is it the KE? Or R? The rate?
No, the cost of capital is KE.
Okay. Let's just say the rate is 12%. Those are the two numbers that we are given. You remember the first principle that we talked about, the cost of capital. The way we are calculating, not weighted average cost of capital, but just cost of capital. We said it's dividends over what? The cost of capital, right? The share price or the KE is what? Dividends over R without considering growth. You remember? So in this case, we're going to say 0.48 as dividends divided by the cost. The share price, the value of the share, the KE, is going to be $4. Are you with me?
Yes.
Where we say KE is equal to D over what? R, or cost of capital. Are you with me, guys?
Yes.
Ashraf, are you with me?
Yes.
Or it's news to you? Or you're just saying news here? Okay, so
I'm following.
We have solved A by finding $4. Okay, let's try solve B. Show how the valuation should change if the expected annual dividend is 0.54. So in that case, what will change? So B, what you're gonna change is the dividend only. The cost of capital is gonna be the same 12%. So what you're gonna say is that 0.54 divided by 12%, which is 0.12. You see, the moment we change the cost of capital, the moment you change the dividend, the cost of equity is changing, it's increasing. Are you following me? It was 4, now it's 4.5. Am I talking to myself or I'm talking to people?
Yes,
You are talking to people.
Are my people here?
yeah.
Yes, your people are here.
Okay, I hope so. So let me copy the formula, paste it here. How can we tackle C?
So with C, now we are changing our D. Oh, we'll not change our D because it's the same. However, we'll change our cost of.
We are changing the cost of capital, right?
So
Okay. So in that case, we're gonna say the cost of capital is 12.5. It's almost 13%. So what has happened to the KE? What has happened to the KE?
the KE is. Oh, okay. Our KE now has changed to 12. Okay. We said our R. Basically, we said our cost of capital is the one. That's R. So
0.48. Okay. 0.48. The R is 13%. We have seen the drop in the share price to 3.48. What do you think is the reason?
because of higher cost of
Yes,
equity.
the higher cost of equity, cost of capital. Rather. Is that difficult, guys?
No.
Okay. So that is without considering the growth. Now let's look at the final example, assuming that there is an element of constant growth. Okay. So ABC company, I suppose that ABC company has just paid annual dividends of 0.48 as given, and the dividends dividends are expected to grow. Expected to grow by 4% each year or annually for the foreseeable future. Okay. Assuming that the cost of capital is 12%. Okay. Then the question is required. Using the dividend growth model, calculate the share price. What should we do here? We are going to employ the formula that we talked about here. Are you with me, guys? Are you with me or you are sleeping now?
We are together. We are together.
You're not sleeping. Is Sydney here?
Yeah.
We are not sleeping.
You're not sleeping. So using G0 plus, okay, open bracket 1 plus G. Are you with me? Then we divide KE and G. Or let's identify the components. G0 is what?
0.48.
0.48. G is what?
G 0.04.
4%.
4%.
And KE?
KE is 12.
KE is 12, eh?
Yes.
I think the 12%, my guy, Ashraf. So in principle, the formula will be this guy here, okay, plus or times open bracket 1 plus this guy here, okay.
Close.
The answer that we find divide by KE is what? 12%, eh?
Yeah.
0.12 minus what?
Minus 4%.
0.04. Okay, 6.24. That's our share price.
Okay.
Is it difficult, guys?
It's quite.
Is it difficult?
No.
Ashraf, is it difficult?
Not difficult.
Okay, I think we
It's
stop there
just
for
practice.
now. Yeah, I gotta practice. I urge you guys to go online or go on in your books. Try to search this topic and do more of practice. Next time we meet, we're gonna talk about the cash flow valuation methods, and if time allows, we'll see whether we can use also income valuation methods. Okay.
Wait for 2 minutes, sir.
Yeah.
I'm not finished yet. I'm still copying.
Okay, I've displayed the formula inside. Assuming you want to copy the numbers.
Yeah, it's fine.
All right. Okay, guys,
I'm done.
there's no question. I'll let you know when we are going to meet again. Otherwise,
All right.
yeah. Cheers.
Thank you.
Thank you, sir.
Cheers. All right.